Stand by SOT1.
Standing.
10 seconds. Ready, rollin'. Ready, SOT1.
Ready.
In 4, 3, 2, 1. Roll in.
From legendary Uncle Studios in beautiful Southern California, welcome to another edition of Work Comp Matters, the central location for you employees, you employers, and of course, we haven't forgotten about you damn independent contractors. And now, here's this week's edition of Work Comp Matters. And it is July 16th, 12 noon straight up. Good afternoon, everybody. Welcome to another edition of Work Comp Matters. We are brought to you by the workcompcentral.com. If you want the number one location for workers' compensation in both California and around the United States, check out the workcompcentral.com. They've got a free 7-day offer. And if you want to pick up their services, I have them. You should too. It's only $1 a day. Work Comp Matters is also brought to you by A1 Law, number one computer management system, 818-357-4120 for your no strings attached money back guarantee. Also only $1 a day. A1 Law. Well, good afternoon, everybody. My name's Steve Appell. As usual, I'm joined by the madman across the water, John Scalia, and my chief of staff, the doctor, but he's not a medical doctor, Mike Zyma. And today we have a special guest. I want to give a warm Work Comp Matters welcome to Mr. Sari, and I'm going to pronounce this wrong. Is it Ibrahim? It's Ibrahim, right?
Right.
Oh, good. I'm glad I got it right, and please forgive me. He contacted me, or an assistant of his contacted me a few weeks ago, if I would have him on. I said, of course, I would love to have you on. He is going to talk for a little bit about the bank on yourself concept and how it is valuable for business owners and real estate investors. Now, I presume that some of our listeners, a lot of our listeners do own real estate, whether it's residential or commercial, but a lot of our a lot of our listeners are business owners, and some are self-employed and some are employees. Of course, our big thing is employees, employers, and independent contractors. And so this is the first time I'm going to get a chance to explore the bank on yourself concept. So go ahead, Sari, take it away.
Yo, thanks for having me on, Steve. I appreciate it.
It's my pleasure.
I've listened to your podcast before, and I kind of wanted to take a different approach to explaining this topic. It is called the bank on yourself concept, and it's a unique concept in that it uses dividend-paying whole life insurance, not necessarily for the death benefit part, but more so for the cash value part. That cash value part of the whole life policy has a lot of functions and benefits, as opposed to other places you would store your cash, like a checking account, savings, money market, brokerage account. The whole life policy is super beneficial for a lot of business owners and real estate investors. It has benefits like safe, guaranteed growth, tax-favored growth, asset protection. It's not affected by any market trends or market conditions. So yeah, definitely, I'll be more than happy to jump more into the bank on yourself concept and how it can help real estate investors.
Well, I think the first thing, because we never really talk about life insurance on the show, I know that, at least from what I know, there are 3 types of life insurance. There is term, there is universal, and there is whole. Is that correct?
That's correct.
Okay, and the term, of course, is normally the least expensive because you buy the policy, you don't have any equity, and then it lasts for a certain term. And then if you don't renew, then boom, it's gone. You have no equity. My understanding is universal life insurance is a combination of term and whole. It costs a little more than term, not as much as whole. And then, of course, whole life insurance has the greatest amount of equity in the policy.
Correct.
Okay, well, I'm glad we clarified that. So please continue.
Definitely. And to take it a step further, so the bank on yourself, it's a concept that uses whole life insurance. And what we mean by the concept is we take whole life insurance, but there's a couple of additional layers to it. Like number one, we only use whole life insurance policies issued by mutual insurance companies. as opposed to stock-owned insurance companies. So mutual insurance companies give their dividends back to the policy owners. The policy owners are also mutual owners of the insurance company, whereas a stock-owned company, the dividends would go to the shareholders. So that's the first thing we do. We only use mutual insurance companies. And the second that we do is...
Well, what is a mutual insurance company? I've never heard the term before.
Yeah, definitely. It's pretty much an insurance company that's owned by the policy owners. Kind of like a credit union is owned by the account holders.
Now I understand. Okay, go ahead.
Yeah, definitely. Yeah. As opposed to stock owned, of course, which is owned by the shareholders. Also, we use companies that have non-direct recognition loan features, and that means that you are not affected by the use of your cash value in a policy. I'll give you an example, Steve. Let's say you have a whole life policy, you have $100,000 in cash value in the policy, and you're a real estate investor, you come across an opportunity that requires you to invest $50,000. You can go to the insurance company, borrow from their funds $50,000, leveraging your $100,000 cash value, and you'll still get interest and dividends on your entire $100,000, even when you're using the $50,000, because you're not subtracting from the $100,000 cash value. You're simply borrowing from the insurance company's funds, and they're not going to recognize the fact that you have that loan when giving you dividends and interest on your money. They're going to keep giving you dividends and interest on your money, regardless of the outstanding loan you have.
What rate are you borrowing it at?
5% simple.
Okay. Go ahead.
Yeah. And then another thing too is these, not just from the financial aspect too, but also from an asset protection standpoint too. In most states, the cash value of the life policy is protected from creditors and predators. It's not necessarily public information, the cash value having.
Are you saying it's judgment free in case of a lawsuit or bankruptcy?
Exactly. Yes.
Okay. Go ahead.
Yeah, definitely. So that's another reason why real estate investors and business owners really enjoy using these policies because of that asset protection, and pretty much other benefits as mentioned. Taxes. The growth of the policy of the cash value is tax free, and in most situations, the withdrawals from the policy are also tax free because you're using after tax dollars, and under current tax law, that's the situation. Another reason is integration. I don't have to necessarily choose, should I, invest in real estate or use this whole life policy thing. I can integrate the two. I can fund the whole life policy and then use it for real estate. And it doesn't necessarily have to be real estate. It could be your business. It could be other businesses that you have. But the point is that you can connect them all together and create your own banking system. You can integrate all your assets together and use whole life insurance to supercharge all these different places.
Now, I'm no investment guru. I know very little, and I don't even pretend to know about investing. In fact, most of the time, and my son Nick will attest to this, when it comes to the stock market, I get screwed up and I never win in the market. So very little amount of my money is in stocks. I know that when you're young, most financial advisors will say, take some chance, take some risk. But of course, when you take chance, when you are more conservative, less risk, the more security that you have. Someone like me, I'm 60 years old. I'm going to be doing like blue chip stocks or something very conservative. For someone like me, let's say I wanted to do business with you. I wanted to cut you a check. What percentage would you recommend putting into stocks? What percentage would you recommend putting into bonds? What percentage of the money would you recommend putting into the type of business that you're talking about now?
Yeah, definitely. So unlike traditional financial advisors, I don't necessarily recommend going directly into the stocks and bonds. I help most of my clients in most situations with the utilization of whole life insurance, and then from there they can then they can use their whole life insurance to fund the stocks and bonds and other things that they want to do. So again, it depends on the situation, and it also depends on the growth they're looking for. I don't really believe in conventional.
What do you think is a reasonable growth for someone who does business with you these days?
Reasonable growth as in, I'm sorry, I'm not following.
Well, you said You mentioned growth. I know traditionally, if you put money in the market and on the average, you can make 10% a year, that's pretty darn successful. You were mentioning that your clients, if I got you right, most of them put the majority of their investment money with you, and then you diversify, and then you mentioned growth. I presume that you meant a average percentage that your clients would be making per year. Am I correct, or did I miss that?
Correct.
Okay. So what would you recommend as a successful growth for your clients?
Definitely. On the whole life part, in terms of the cash that builds in the whole life policy, we can project, actually, not just recommend, but we can project a growth of about 3 to 5% guaranteed every year. And then from the funds they use, they could use that to, earn another 10% on their money in other places that they might have.
What other places?
Like real estate, their business, stocks, wherever they want to kind of, the whole point of the bank on yourself concept is controlling the underlying assets that you're investing in. It's taking control of your investments and not necessarily, just writing a check and giving to a financial advisor and then, waiting for an ROI or return on your investment. It's more of taking control and ownership of the investments of your money and being able to control everything. That way, when something happens in the stock market and stocks go down and pretty much it takes a hit, your funds aren't taking a hit too, because the core of your investments would be in whole life insurance, which is not affected by market volatility. And of course, the funds that you're using the whole life insurance for, you would own those underlying assets, like your business and like real estate that you own.
Dr. Mike, you're a pretty conservative dude when it comes to investing. And we were talking before the show about Mr. Abraham. If I pronounce that right, please forgive me. Do you have a question for him?
Well, I just have trouble, and maybe this is my fault. Maybe I'm just being dense.
I can tell you right now it's your fault in being dense, but ask anyways.
I don't understand the concept of guaranteed growth, number one. And number two, I don't understand how these investments are not impacted by any market conditions, number one and two.
Okay, well, that's a good point, and a friendly reminder on the mute. So guaranteed growth, and how are these investments not dependent on market factors?
Yeah, definitely. Good questions. So we only use, as mentioned earlier, we only use mutual insurance companies. And not only that, but we only use insurance companies that have been in existence for over 160 years. They've been around for over 160 years. And they've been paying dividends to their policy owners / the insureds, the customers, for over 160 years. Although dividends aren't guaranteed, the growth is guaranteed because they've been paying for over 160 years, and their insurance companies are highly regulated, so they don't participate in high risk investments or speculative investments. They can only invest in the bond market, and about 60 to about 70% of their portfolio is made up in the bond market, and the rest of their portfolio is given out on personal loans to their insureds or to other corporations or banks. They would give them loans. So pretty much they're able to guarantee growth, and they have proven track records. The insurance companies we work with have proven track records of providing guaranteed growth to their policy owners via the cash benefits, the cash value benefits, as well as the death benefits. And also from a regulatory standpoint too, insurance companies are highly regulated. They're constantly audited, and they have to prove that they have enough cash value for their insureds, as well as they're able to provide the death benefits to their customers.
That was a mouthful. I got to tell you, before we go to the break in the news, John Scalia, madman across the water, do you have a question for our guest on the bank on yourself?
Yeah. What's your educational background? What degrees do you have? And are you a certified financial analyst?
Oh, awesome. Yeah, good questions. I have a master's degree in business. The Bank on Yourself organization has their own training program. It's like an 8-week training program. I went through that. My experience I've been licensed insurance agent for about 5 years. And a lot of my background includes financial planning and Medicare consulting. And no, I'm not a financial planner yet. I'm in the process of becoming a financial planner. Hope that answers your question.
Okay.
Absolutely.
Where's your MBA from? Where's
Well,
your MBA from?
I suspect that John and Mike will both have questions after the break. So guys, get those ready. But it is time for the break. My guest is Sari Abraham, and he is with the Bank on Yourself, and we're talking to him about different ways of investing for both business owners and employers. My name's Steve Appell. You're dialed into Work Comp Matters. We are brought to you by workcompcentral.com. If you want the #1 location for workers' compensation in both California and around the United States, check out workcompcentral.com. They've got a free 7-day offer. And if you want to pick up their services, it's only $1 a day. We're also brought to you by A1 Law, #1 computer management system, 818-357-4120. The next 2 weeks are shaping up to be critical for California as officials wait to see if the sweeping restrictions imposed in late June and July show any signs of slowing the rapid spread of coronavirus in communities across the state. This week was marked by a series of grim milestones as California shattered a one-day record for new coronavirus cases, more than 11,000 on Tuesday, as well as rising infection rates and growing number of hospitalizations. Because the coronavirus can take weeks to incubate, much of the current surge is still tied to people exposed to the virus in June, as counties rapidly reopen the economy and many return to old but now dangerous routines, such as bar hopping and attending parties and other social events. Many also return to workplaces that didn't implement new safety protocols. Well, I don't know anybody that's been bar hopping or anything like that, but you kids, don't do it. Don't go. Do not go to COVID-19 parties, and don't bar hop. Mike, go ahead and give me one news story, please.
The William S. Hart Union High School District officials announced they'll have students, teachers, and staff working online for the beginning of the school year this fall, and after a few weeks, they'll decide whether to return to campus. The district had been deciding between a blended model, having different groups of students come to school on different days, an online-only model like the spring, or a complete return to campus. Quote, I am recommending tonight that the governing board temporarily authorize the start of the school year in an online instruction format, end quote, Superintendent Mike Kuhlman said at Wednesday's meeting. Quote, I recommended that we establish target date of 5 weeks for this temporary revision, which coincides with the first progress reporting period, end quote. Making this decision now, Kuhlman said, would allow for the district to immediately pivot to teaching teachers how to conduct live online instruction and improve upon what they had learned during the spring semester. After school begins on August 11 and following a 5-week period online, district officials could look at considering the blended model they had previously discussed while working to ensure the safety of those on campus. Ultimately, the board voted 5-0 in favor of the superintendent's recommendation, which called for online learning at the beginning of the semester with a plan to revisit the topic 5 weeks into the semester. Now, folks, that's from a story, the Newhall Signal, the local newspaper up there. And I had been keeping my ear to the ground to see what the Hart School District was going to do. And I think that this is well-reasoned, and I think this is a good idea.
Thank you, Mike. We're now going to go over to Munich, Germany, and the madman across the water, John Scalia. Give me one story, babe.
LA Latino Black students suffer deep disparities in online learning, records show. More than 50,000 Black and Latino middle and high school students in Los Angeles did not regularly participate in the school system's main platform for virtual classrooms after campuses closed in March, a reflection of the deep disparities faced by students of color amid the COVID-19 pandemic and of the difficulties ahead as LA Unified prepares for continued online learning. Editorial comment. That was one sentence. They need more editors. Okay, next paragraph.
Thank you. Oh, go ahead, John. Go ahead.
The numbers reflected in a first-of-its-kind report by LA Unified School District analysts examining student engagement during campus closures paint a stark picture of students in the nation's second-largest school district struggling under the new pressures of online learning. Nearly every category of students, sorted by race, income, and learning needs, included large numbers who did not regularly participate in distance learning. But low-income students and Black and Latino students showed participation rates between 10 and 20 percentage points lower than white and Asian peers. Okay, that's the article goes on, but you get the idea.
All right. Thank you very much. My name's Steve Appell. You're dialed into Work Comp Matters. We are speaking with my special guest, Mr. Sari Abraham. I'm pronouncing it wrong. I'm so sorry. And he is part of the bank on yourself. I'm sorry. Thank you. Bank on yourself concept. This show is geared towards employees, employers, and independent contractors. And we were talking about some basics of your business. So go ahead. What else? Tell me something fascinating about what you do that you haven't discussed yet.
Yeah, definitely. So I really enjoy, helping clients, protect their wealth and actually be able to keep it. If you have, think about, conventional or traditional investments, like having your money simply in the stock market or, paper money, ask yourself, is that real wealth? Like, do you actually own that? Well, that wealth is wealth when it's actually cash in your hands, right? It's an asset. Yeah. But I like to actually help my clients keep their wealth, keep their profits in their business. Some of my clients, I help them allocate, a certain percentage of their sales, like maybe, 5 or 10% that can go directly into these whole life policies. This way they can retain and hold their profits and still earn interest and dividends on those profits. And if they need it for their business or for their personal life or whatever happens in life, they always have access to that money. The insurance companies will always give you 85 to 90% of your cash value, regardless of your situation, whether you're going through a bankruptcy or you have terrible credit or you don't have any collateral at all outside of the insurance policy. They'll still give you the loan. So it's like having a friend that you can keep money with, but that friend will always be around. You can trust that friend with any amount of money, regardless of market conditions,
But if you take money out, doesn't that reduce the payoff amount of the policy?
So when you take money out of the policy, you're actually it's a personal loan from the insurance company. You're borrowing from the insurance company's funds, their general funds. And you have a loan agreement now with the insurance company. And if you don't pay them back, for example, and you pass away within that time period, they just subtract that from your death benefit. And your death benefit is usually, 10 to 20 times your cash value.
What do you recommend, let's say someone who's just starting out in their 20s, and then someone who's maybe in their 50s or 60s, to insure themselves for life insurance?
Yeah, definitely. I think it's a mindset shift. Just get in the habit of starting a policy. The first year, you're not going to see that much cash growth, but that's not necessarily, I think you should still do it, even though the cash value in year one is still going to be relatively low in comparison to other things you might do. But just get in the habit. If you're in your 20s, get in the habit of putting some money somewhere where that money will be, that money can triple, in your future. Just being able to earn interest and dividends on your money. And if you're in your 50s and 60s, I would restructure and think about, the legacy that you want to leave. Do you want to leave a tax-free, legacy and be able to kind of use your retirement, actually be able to use the retirement that you've been building your whole life? And a bank on yourself policy can absolutely be used for those reasons. You could use it for retirement, for legacy continuation, for pretty much almost anything financially that you want to accomplish.
I have a single family residence. When I pass away, it goes to my kids. I currently have a mortgage. So my life insurance, at a minimum, most people would say, would be the payoff amount of the mortgage. If I want to insure myself for anything else that I might want to cover for my kids, I would do that. But most people should, at a minimum, insure themselves for the payoff on their mortgage. Would you agree with that, or no?
Yeah, absolutely. I think that's definitely one angle to address is, if, your mortgage, absolutely, to reduce the burden on your kids. That's one angle. Yeah. And then also, they're if they're still young, they're not in college yet, their college tuition, if you have debt, to cover your debt. So it's a kind of like, numerous angles to address in the estate planning process.
John Scalia out in Munich, Germany. Are you leaving everything to your kids?
Yeah, pretty much. I have a bequest to one of my universities, but other than that, everything goes to the kids. Yeah.
That's great. Mike Zyma, you leaving everything to the kids?
Yeah. I have a question.
Sure. No, see, notice neither one of them are leaving anything to Steve Appell, but go ahead, ask your question.
Sorry, what is the minimum amount of dough that it would take to get involved with your products?
That is an excellent question. And before you answer, there are some financial advisors out there that will accept like as low as $5,000 to start, and other won't even talk to you unless you've got 50 or 100 grand. So that's an excellent question. Go ahead. Thank you, Mike, for asking that.
Yeah, that's a good question. So there's no minimum, but to see some results in your first year, it's about $300 a month. And there is different ways to structure the policies. You could do monthly payments into a policy. And again, it's probably around $300 would be a good start. And then you could also do like a single premium whole life policy. That's when you take one payment. Like, for example, if you came across a large windfall of like $200,000 or $300,000, you could take all those funds, roll it into a policy. So it comes down to the client situation, where they're at right now financially, where they want to go. And then we try to apply the whole life policy to their specific situation.
And what type of death benefit do they get for $300 a month?
Okay, let's say that.
By the way, we got about 3 minutes left. The show's gone by really fast. But what type of death benefit do they get for $300 a month?
Yeah, definitely. So if they're 30 years old, let's just say 30, for $300 a month, you would probably get a death benefit of about $300,000, and you can probably build up cash value in the first year. Maybe half of that could be cash value in the first year, depending on how it's structured. But I would say half of that. You
mean $150 a month can be cash value?
Exactly. Yeah. Good point. Yeah.
Well, I was asking. I didn't know.
Yeah.
Okay.
Yeah. Exactly. Yes. And
then you said, if I'm not mistaken, that as you build up your cash value, you're going to pretty much guarantee a return of a 3 to 5% additionally on your investment. Correct?
Correct.
That's excellent. John, we've got about a minute or two left. Do you have another follow-up question?
No.
Okay. It's been a pleasure having you as a guest on Work Comp Matters. Would you like to give the audience, again, your name, address, email, website? Go ahead and take a minute and knock yourself out.
Yeah, thank you. Thank you, Steve. So it's my name is Sarah Ibrahim, and you can find me if you want a free consultation. You can go to finassetprotection.com. That's FIN assetprotection.com, and all my consultations are free, and I'll be more than happy to talk to you about your current situation.
And I thank you very much for coming on to Work Comp Matters. It's you've been a great addition to the show. I would also like to thank the madman across the water, John Scalia, as well as my chief of staff, Dr. Mike Zyma, Scott Walton of legendary Uncle Studio, and all the good people back at WorkCompCentral. My name is Steve Appell. We'll see you again tomorrow at noon for another edition of Work Comp Matters.